All right, let's kick off.
So thanks everyone for joining our webinar. Today, hopefully I can give you some insights into where I think the economy is, where the market is, um, and also showcase one of our key projects. Key thing I will say is that we will only show projects that we have buy-in into and that we really believe that we should showcase to our clients and prospects. And so hopefully we will make your next 40 minutes worth your while. You can see my background on the screen. I have had a long banking career where I held a lot of senior roles with the Westpac Group as well as with HSBC, where I was CFO and COO. I've also had a lot to do with the industry and industry committees. So you can see there that I've been on the Australian Swift board, been on the advisory committee for EFMA as well as the Sydney Futures Exchange, and most importantly, have had a lot to do with RBA and APRA. So hopefully, I can give you some insights into how they think, what makes them tick, and make it related to the property market. Okay, without further ado, this is an interesting slide because it actually gives you some insights into where the asset classes are that you can invest in. And you see on the left there that residential real estate actually makes up 11.5 trillion of uh, by far the biggest asset class that we have in Australia. The superannuation fund is 4.1 trillion, listed stocks 3.4, and so on. Now, the key thing on this slide is if you look on the right here, you can see that the outstanding mortgage debt, and that's the mortgage debt on the residential real estate, is only 2.4 trillion. And the point there is that a lot of homes in Australia, a lot of properties in Australia are actually paid off. So if this is the actual value of the properties in the residential real estate asset class, we've only got 2.4 trillion on the loan side. Okay. So the thing to remember here is that when interest rates go up, it does not impact everybody. There are a lot of people who are my age group, who are sort of what we call baby boomers in Australia, who have their houses paid off and some investment properties paid off. So it's not if you look at the total LBR, it's only 20.9% of that. The other thing I will say is that if you want to generate wealth in Australia, you have to be in this asset class. You definitely have to participate in this asset class. One of the things that makes Australians the richest per capita in the world is in fact that they invest in residential real estate. Okay, I won't dwell on that, but keep going. What's making headlines at the moment? So the few things here. I mean, there's a lot of things making headlines, but those that are relevant for us and the property market. Inflation rises to highest level in over 12 months. That's not good for further interest rate cuts, but we'll talk more about that in a minute. Australia's unemployment rate jumps to 4.5%. Is that good? Is that bad? Well, we've been stuck at or between 4 and 4.2 for quite a while now. So it is a little bit of a jump, but how important is that in terms of the overall market? We'll talk about that shortly. And third, we're not immune to what's happening globally. So Trump tariff live updates, there's issues every time Trump opens his mouth. Obviously, the market either is positive or negative. So that's going to be something that will be ongoing for quite a while. And whilst it doesn't have a huge impact on us, it can have some indirect impacts on us. And we'll talk about that as well shortly. Okay, so what really moves the needle when it comes to property prices? These are my top seven, has been my top seven for a good 10 years that I've been doing these presentations. Of course, a few little tweaks in the bottom here with sort of COVID-19 and so on, but mostly these are the top seven in somewhat order. So the number one is supply versus demand. It is absolutely key with any commodity, whether it be property or cars or just about anything. If you got too much of supply, you can't expect prices to actually go up. So this equation is absolutely key and one of the key factors why the property market has, has remained strong throughout the period of interest rate increases. It's just been a mismatch between supply and demand. And demand seems to keep increasing and supply can't keep up with it. Interest rates and affordability also extremely important. And the two key things that have an impact on the interest rates, firstly, inflation, which everybody is focused on now, everybody knows what that is, and wages growth. Wages growth and productivity are also very, very important. Third one there is the regulation, and the regulators there, key ones are APRA, who regulate banks, and the RBA. One of the things we all need to be very mindful of is that to have a healthy property market, you need to have a very healthy banking system and a very healthy regulator. And we saw in the global financial crisis, there were a lot of banks that actually went down. A lot had to be salvaged by the regulators, like Merrill Lynch and so on in the US, and a number of banks like Lloyd's and Barclays, etc., in the UK, who had to be salvaged. So it's key, it's important that we have a healthy banking system. And I can tell you that our banking system in Australia is extremely healthy. Our top four banks, even though they get a lot of criticism from all sides, they are in the top 20 in the world. For a country our size and an economy our size, we are definitely punching above our weight when it comes to how the strength of our banking system. Okay, APRA was recognized as the best regulator in the world post the global financial crisis a few years back. So they have a lot of levers to pull to regulate banks, and so but I won't go through that in any detail at the moment, but happy to take questions later. Fourthly, and very importantly, we have got to have a healthy GDP and an unemployment rate which is also healthy. So we have had number five, the government spending, infrastructure, and incentives, which is actually helping our GDP, helping our unemployment, and we're gonna give a lot of credit to the state governments and the federal government for making sure that they're keeping that GDP and unemployment in check. Because if it wasn't for the infrastructure projects, if it wasn't for the defense spending, and if it wasn't for the number of people that are coming into the country, you would not have GDP growing. We would be in a recession. So absolutely key that government keeps doing what they are doing, whichever government it is, and that the GDP and unemployment is in a good place. Okay, for property market, it's very important. Number six there is also important. And what I mean by delinquencies and loan write-offs, and you probably haven't heard the term delinquencies much, but they're used in the banking. That is to do with the assets that you are that are going to be written off. Okay, so when a loan becomes delinquent, if you haven't paid your loan 1 month, 2 months, 3 months, you get a few nasty letters from the bank, and then one day you get a knock on the door, and they do what's called a mortgage in possession. So they take your house and they auction it. So they take out what the loan amount is and the accrued interest, and whatever's left they give to you. We don't see many mortgagee in possession sales anymore. Okay, so I have been around in this property market for a good 43 years. I've seen probably about 7 or 8 cycles during that period. And I can tell you that the last time I saw significant issues with delinquencies and loan write-offs and mortgage in possession sales was back in the early 80s, 82, 83, okay, in that period, when we had a real recession. So when I'm talking about a real recession, what I'm talking about is unemployment was at about 7.9. Interest rates were up there at around 17%. I paid 17% for my first my first mortgage. And we would go to mortgagee in possession sales and nobody would turn up. Okay, they were everywhere. Nobody would turn up, and that's what causes price pressure on property prices, and property prices come down as a result. I'm sure that all of you would agree that if we had a mortgagee in possession sale today, there would be at least 20 people out there going in and trying to get a bargain. And they will end up disappointed because they're not going to end up getting a bargain. Okay. And that's the market today. So when we're talking about delinquencies and write-offs in the residential mortgage space, there is nothing to write home about. The delinquency rates today in residential mortgages is lower than it was pre-COVID. Okay, it's a fractional number. So we don't have anything to worry about. And so when you see the media saying, oh my God, delinquencies have gone up by 10%, they're talking about a minuscule 10% on a 0.5% is not a lot, right? So it's just to make headlines. I can tell you as an ex-banker, we have nothing to worry about on the delinquency side. Current affairs will make a program, people sleeping in cars and all that type of stuff. Well, take it with a grain of salt, because really we don't have an issue. Of course, there's some pain points in the economy, and there's some pain points in households, but it's not significant. Global factors, last but not least, trade wars, all of these factors, foreign exchange rates, the bond and equity markets. When the bond and equity markets actually collapses, people feel a lot poorer in their pocket. It's what happens in your hip pocket. If everybody feels poorer and your super fund is going down and everything else is happening around you that is all doom and gloom, then your confidence is not there to go and buy a property. So these are factors, they're real factors, but they're not primary factors, okay? They're consequential factors. I'm sure there's a lot of other factors, but they're the key ones that I normally talk about in that order. So the key one was demand and supply. So where is the demand coming from? I think it's no secret, and there's been a lot of marching in the streets lately, not just here, but in other countries as well, because our migration rate is at an all-time high, I would say, okay? We need a lot of people in this country for a number of reasons. Reason number one is we've got a skill shortage. We all know that. We've got a massive skill shortage. Number two, we actually have an aging population. People, so the politicians who are trying to scaremonger you, and trying to curb the migration, what they don't understand is why we actually need migration. So one of the key factors why we need migration is that, some people say, well, they help come and grow our GDP, which they do. Every migrant that comes here, they need to go and buy white goods. They've got to go to the JB Hi-Fi and Harvey Norman and buy all the furniture and everything else. And that keeps the economy ticking up. But with the aging population, we have got somewhere between 250 and 300,000 people who are going on the pension every year. That's a massive amount of people. The government needs that many people to come in and hit the ground running and start paying taxes to be able to fund that type of retirement. Otherwise, the retirement age will keep going up, and we will have more people marching on the streets. Okay, so that's the key factor. You can read all of the other reasons there, but there is a lot of foreign money coming into property still. Okay, it was all Southeast Asia, but now there's a lot of interest from Japan. There's a lot of interest also from certain countries in Europe. Okay, so because the returns that they are getting in those countries is so minuscule. I mean, if I take Japan as an example, well, Japan has 100,000 properties which are empty. The maximum interest rate you're going to get in Japan if you do a fixed deposit for a year is 0.25%. They're a country that had sort of negative interest rate the cash rate was negative. So in Europe, in certain countries as well, places like Portugal and a number of other countries, similar issue. your returns in this space is very, very low. So they're happy to come here and even get 4 or 5% return. So the build to rent space is really gonna, you'll see that that's gonna really take off, because there's a lot of this foreign money coming here where they're interested in property. They've seen the history. They know that property is gonna get them those type of returns. Okay. So demand is coming from a number of areas. Rental vacancies, another important thing that we've got to, focus on. And those of you who may be renting, that we have got a chronic issue here with vacancy rates at 1.2% nationally, and September figure was not any better. I haven't updated this slide. Apologies. Is at 1.2 is not healthy at all. Okay, and some cities there you can see are even worse. So the important thing here is that we've got to address this, because there's a huge supply and demand inequation again. So what's a healthy vacancy rate? A healthy vacancy rate is somewhere between 2.5 and 3%. Right now it's at chronic levels, and that's why rents are going up and up and up and up. I don't know how that's going to be sustained, but that is a problem that the government is trying to address. Now, GDP. Economic growth is absolutely important. Okay? Nothing will function without economic growth. So we have seen, surprisingly, I have been very surprised that the last quarter growth was 0.6%. Okay. Now we've had a big period of pretty much a lull period over here. Not much was happening. This is quarter by quarter, so you can see that there is nothing much happening here. And then this was obviously this was COVID, and then we had a brief one here, but these were more COVID induced. Whereas here, we've had very, very low 0.2, 0.3, and the GDP per capita over this long period here was negative. Now we're in a little bit of positive territory, so GDP per capita has actually jumped up a little bit, 0.2. Okay. And what do I mean by GDP per capita? What it means is that what are all of you feeling in your hip pocket? Okay, as a household, do you feel that you are saving money? Do you feel you're getting ahead? Okay, if you're going backwards, then that's, your GDP per capita in your household is going negative. So I think all of you would know that there have been some pretty, there have been some pain points over the last few years, definitely. Okay. Cash rates history. Now everybody knows what everybody's focused on the cash rate and where it's going. There was a time when, nobody knew what the cash rate was. Okay. It's called the OCR. The RBA calls it the overnight cash rate. The cash rate really is something that the banks use to price their variable rate housing loan. Just the variable rate housing loan, not the fixed rate housing loan. Okay. So we're now at a good place. We've had some falls. You can see all the way from 1990. You remember I said I paid 17% for my first housing loan? Well, it's real. It was here. So when people tell me, 6% I'm paying, it's too high. I know this generation feels it's too high. I don't think they know what high actually means, okay? So over this long period between 1990 and now, the average cash rate has been 5%. That's the blue line here. So we never reached 5%. We didn't reach the average. And now we're actually coming down. So we're at 3.65, which is a good place. And we'll talk in a minute about where we think interest rates might be going. We've had a few easing cycles here. 1, 2, 3, 4, long one here, 5, and this is the 6th easing cycle in this period. Okay, so in a long period. I'll come back to this in a minute. But before I move on from this, the other thing we got to think about is the fixed rate. So the fixed rate that the bank offers you 1 year, 2 year, 3 year, 5 year fixed rates on mortgages has nothing to do with the cash rates. Absolutely nothing. Okay. The fixed rates are based on the bond market, the interest rate swap market, and the futures market. Those three markets, you build a yield curve, and that's how you set the pricing on the fixed rate. When bond prices and swaps prices actually fall, okay, so in the US, we've had some recent falls. Banks can start offering you better fixed rates because they lock in the fixed rates using derivatives. Not the right time to discuss that, but I used to set the fixed rates for HSBC when I was the CFO there, okay, and the head of global markets operations. So, but that's a topic for another day. But it's important to note that fixed rates can fall below variable rates, and you got to pick the right time to go and fix your mortgages and investment loans. Okay. And so you saw that during COVID, fixed rates came down to 1.89. That was the lowest rate I saw. And variable rates were still around the 2.6, 2.57. Okay. But we'll take some questions, chat about that later. Now, every time there's been an easing cycle, so change in house prices 2 years after the start of a rate cut cycle. So our rate cut started back in February. And what this chart is actually showing us is how much property prices have gone up in the first 2 years after the start of a rate cut cycle. So from February 2025 to February 2027, if all things are equal, you should see somewhere an average of around 15, 16, maybe if the supply and demand equation stays the way it is, you could even see 20%, which is very healthy over a 2-year period. Okay. So, I mean, yes, we've had 2021. Anybody listening to me today who held a property before 2021, happy days. Prices did jump a lot. Yes. Now we have a few 15% periods here. We got a 32% in 2003 and a very abnormal one here in 1988. Okay. And this was like I was talking about before, 17%. Prices, then rates dropped quite heavily in a short period of time. From the 17 came down to about 10 or 11%, and that sort of caused that. But keep that in mind, because right now the property prices have started to go up a little bit, and it's an excellent, if you haven't got back into the property market, you need to get into the property market now, because I can put my hand on my heart and say a 15% jump is almost definite, but you could see much more than that in the current market with the supply and demand in equation. Okay. Inflation now. So as I said before in that news item, inflation, the underlying inflation has actually increased to 3%, which is a slight up from where we were before. And there's a slight decline actually in the trimmed mean figure. Okay. But we're going to watch this closely. We want the inflation to be between 2 and 3. RBA, we're very happy with the previous numbers. You see down here, the previous numbers were pretty good, and there's a bit of a spike in both of these. If it goes above 3, you can forget about another interest rate cut for a long time. Okay, so this figure is absolutely key. Every time it comes out, you got to keep an eye on it. The other one is unemployment. The unemployment rate, as I said, has jumped a little bit. So it's been lurking around that 4 to 4.2 for quite a while now, quite a number of months, and suddenly 4.5 is the RBA. So the news media starts coming out and saying, here we go, unemployment's jumped, rate cut. Absolutely no way. No way. Okay. Why? Because 4.5 is still almost like everybody's employed. If you can't find a job right now, it's not the market. Okay, you got to blame yourself. Now, pre-COVID, you look at pre-COVID here, inflation, I mean, unemployment was above 5 all the way through. All the way, you were 6 here, all the way through. Did we have a good economic outcome at that time? Of course we did. This is an anomaly. Okay, this is the what happened with COVID. Went down here, and then it's slowly coming up. Is it gonna go up some more? Yes, it is. Is it gonna get to 5? Yes, it is. It's only a matter of time. Okay, could take another 3 months, 4 months, it'll get to 5. The RBA already has budgeted for this to go to 5, 5.1, 5.2, back to where we actually were. At 5, even at 5, it's not going to have a big impact on the interest rate decision. No, absolutely not. So do not believe the media on this, okay? So before I get into this, if unemployment is where it is and maybe ticking up and down a little bit around that 4.5 to 5, and if the inflation number is around 3 and maybe a tick higher than 3, forget about another cut for a long time. Okay? They are the key things that we need to have a look at. Absolutely critical. Now, the banks had, factored in another 3 cuts, another 2 cuts. NAB was like at 4 cuts. Now they've all pretty much retreated. And they're basically saying cuts in 2026, CBA's at 1, NAB's at 1, ANZ, Westpac's now bullish suddenly. Okay. So the thing is, these banks change their sentiment every time a big figure comes out. My personal view is I don't think, unless some really drastic thing happens in the geopolitical side, our key economic fundamentals are not going to actually move the needle on interest rates in the near future. I suspect it just depends on those numbers that I've just talked about. If those numbers continue to stay where they are, I can't see a cut in the near future. Okay, so that's where I am. That's where the big banks are. Now, in terms of property price forecast, so this was what was there late last year. Okay, so CBA predicted that, and so on and so forth. The banks are very cautious now in terms of predicting increases because they've put their neck out before, and they've been beaten a few times. So now they're very subdued. You can see with those increases that they've got there, it's very modest. Now I am predicting 8 to 12% this year. Now I know we are end of October now. Okay, we've got only November and December to go, and October also. October numbers haven't come out. For October, November, December, 3 months to go. I am very bullish that the annual number will be closer to what I have got than any of these other banks have got. Okay, I haven't changed this slide. I'm happy to take criticism when I'm not right, but I think most of my listeners over the last 5 years will tell you that I get it right about 95% of the time. So I am still backing what I'm saying. Is it possible to get to 8%? Well, still got November and December to go. I would say we would get very close to the bottom end of my prediction. But let's see. Time will tell in January where I get to. Okay. Okay. I will stop there and take questions later on, of course. But I will pass on to Krish now to talk about the project.
Thank you, Sachin. Good evening, ladies and gentlemen. My name's Chris from Nivas Real Estate. Now, I wanted to just take you through this brand new completed project called Maiden Place, which we have located in Penrith. Now, I'll take you through a few slides. I won't be too long, but I'm going to give you a good feel for what this project is all about. Now, if we jump onto the next slide, Sachin.
Yep.
Thank you. So, first and foremost, the developer builder for this particular project is Cadence. They were established in 2011. They've done multiple projects right across Sydney and particularly in the North Shore. And they are a fantastic builder, which is, as you can see, have been awarded multiple times as well. So, a very good quality builder who have delivered a fantastic product in Penrith. Now, so it's the next slide. So these are just a few of the projects which they've completed. You can see at Long Beach, Pymble, Bexley, Ryde. So that's just a bit of a taste of what they've done in the past. So as you can see, unique designs, nothing which is, cookie cutter looking. They're very nicely architecturally designed buildings. As you can see, the finishes in the interiors are superb. They focus on getting a lot of light in the apartments, and yeah, they're very nicely done. Now, just a couple of points about why Penrith. Now, as Sachin was mentioning earlier, the rental vacancy rates in Sydney are low. Penrith is also quite low at 0.6%. Basically, at 3%, a rental vacancy of 3% is healthy, but 0.6% is chronically low. Now, the current population is roughly around 230 residents in Penrith and Greater Penrith. That's forecasted to jump to 260,000 residents by 2031. By 2041, you're looking at closer to 300,000 residents. Now, bear in mind, guys, this is an established suburb, as you know. So, for that sort of growth to happen in an established suburb where land is already quite tight, it's growing quite fast. So that supply demand equation, where there is a significant amount of demand and low supply, is definitely playing out. Now, the expected demand for homes up until 2029 is 10,000 new households are required, right? Now, if you look at the next point, there's 7 townhouses and 85 blocks of land to be released within 2025. I believe those lands are delayed somewhat, and not much more is planned over the next 3 years. So you can see they're well and truly short of those 10,000 new households. So that supply demand equation is just going to keep getting chronically worse in Penrith, but better for investors. So jump to the next slide. Now, in terms of infrastructure, I've put the new international airport first because you're only about 20 minutes away from this particular project. You've got Bradfield City Centre, which is the new Aerotropolis as well, which is again about 20 minutes drive away. There's going to be around 25,000 new jobs created just in the Aerotropolis. You've got companies like, I believe Samsung and Google have signed a memorandum of understanding there as well. So you're getting some very big companies going down towards that direction too. So Penrith is obviously going to be a beneficiary of this, hence why I've added those 2 points first. Now, the third point is Nepean Hospital is already massive, but they're redeveloping, and stage two is going to be, or stage two of the redevelopment will be finishing in around February 2026, not too far away. The other thing is the Penrith Stadium redevelopment. That's a $309 million project, which again is underway, and that's going to do a lot of good thing for the Penrith Panthers fans, and obviously going to bring in a lot more people into the area because they're going to have entertainment and shops and restaurants and all that sort of stuff around it. So it's going to be a lot more like Sydney Olympic Park than just a stadium and that's it. So you're going to have a lot of facilities around that. Plus, on top of that, Penrith has got a Western Sydney University campus in Warrington and TAFE as well. So those two institutions will also be expanding as well. And the only reason why they do these sort of expansions, especially, hundreds of millions on a hospital and education, is because the population is growing, right? They have to cater for that. So it's all part and parcel of that exponential growth it's going to experience. We'll jump onto the next slide. Now, just a quick understanding of what the interior finishes look like. So you've got 2.7 meter ceilings, Daikin ducted air conditioning, 20 mm stone bench tops, ducted range hood, and more. So, I mean, these are very well finished apartments. As mentioned, they are completed, so we can go through and have a proper look at everything. And they are literally, we'll go through the location in a minute, but it's very well located as well. So the location. So you're located on Derby Street, as you can see there. Where you look to your right-hand side where it's got number 10, that's your hospital. So that's an Nepean Hospital, literally 7 minutes walk from the site. Then if you go up to the top where you see the broken dotted line, that number 1 is actually Penrith Station, right? So you're about a literally 1.5, 2 minute drive from there, if that. Then number 2 you see there, that is actually Penrith Westfield. Again, about a 2 minute drive from the site as well. And literally down the street from Derby Street, you've got a park, you've got all the infrastructure that, a modern CBD has because Penrith is a CBD. So there's parkland, there's shops, restaurants, doctor surgery, hospital, university, TAFE, everything that you could possibly want in a suburb is there, right? Because as I mentioned, it's established and everything established is getting expanded. So amazing location. And pop to the next slide. I'm just going to give you a very brief sort of overview as to what the plans look like. If you want to or are interested in this, we can go through this with you in more detail, show you the display, go through all the plans, etc. But just to give you an idea, the 2 bedroom apartments are starting from 699. This is 74 square meters internal, 10 square meters external. You've got a island bench top, not a galley kitchen. So nicely finished, square, good designs. You've got a little study nook as well. So they're essentially a 2 bed plus study. So very well priced, especially for the suburb, which again, I'll get into a few competitors' offerings as well to show you how good this value really is. So look, very well priced for Penrith. 1 bedrooms from 579, so 50 square meters internal, 10 external. Again, you get a little study nook, as you can see, big bedroom, and a really nice unit. So very well finished, as you saw from before. Square, no wasted space, no curves and things like that. So again, very nicely done. Then as we pop to the next slide, this is just to put in perspective what other brand new 2 bedroom units are selling for. And you're going to be very surprised. So your 2 bed, 2 bath, 1 cars, which is not too far away from us, about 5 minutes drive, that is starting, your 2 bedrooms are starting from 850. You're starting. The sizes are not too indifferent from where we are. Finishes are relatively comparable, right? And this is the pricing is, it's 150,000 from where we are. So you can see the value proposition of our particular project is sensational. Then you've got on the right-hand side, you've got Eastside Quarter. Eastside Quarter are starting from 915 for their 2 bedrooms and 650 for their 1 bedrooms. So again, the value proposition is amazing with our project. Now, of course, these projects, they've got pools and gyms and saunas and all the rest of it, right? So they've got all those facilities, but you're going to be paying that in your strata as well. Okay. So the value proposition from what we're offering, lower strata, equally as good location, and 150K under what the competition are offering. So at a minimum. So, guys, I just wanted to give you a good understanding of the project. We have a display suite ready. I'm going to be sending everybody who has registered a copy of the video of the display straight after we're done. We can book in appointments anytime. We've got access, we've got access basically all the time. We've got a display suite there. I can show you through, and it is an amazing opportunity. And look, your rental yields are quite strong as well, for investors, very strong. And look, it's an amazing project that suits both investors and owner-occupiers alike. So please do contact us if you feel like you need any further information, or if I can book you through the display, and I'd love to show you through. Either myself, Raj, and Lenny, we can definitely show you through, most definitely. So thank you so much for your time.
Okay, happy to take any questions on the project or from the economy side. Yep, got a few things in the chat there.
Yeah, just having a look at the chat. Okay, AS has asked, any chance of a rate cut in November thanks to high unemployment figures? I think you answered that one, but yeah,
Yeah, listen, it's that unemployment has to go up to somewhere around that before it has any before it gets the RBA concerned or worried. It has to be around the 5.2 and above. So if it gets there quickly, and the key, the key is actually inflation. So unemployment was, not a big factor where it is at the moment. So if inflation goes back to sort of below 2.5, you've got a better chance of rates being cut. So if inflation is around 2.5, including the trim mean, and we should then have, the cash rate closer to 3. But at the moment, I just can't see that happening.
perfect. All right, the question that we get quite often, what are your thoughts on an investment property in Ballarat, Geelong, Bendigo, and around Melbourne? If a good proposition, any help? Manan, I'd be more than happy to discuss this with you offline. We definitely do have options in and around Melbourne. We are bullish about Melbourne, most definitely. We've been looking at Melbourne for the last 12 months. So we've sort of before all the hype, we found the market had bottomed out and have definitely got some good options there. So look, please do get in touch with myself or Raj, and we'd be happy to show you all the options we've got there. But in a nutshell, yes, it's a good place to invest at the moment. Correct. And Sachin, if you had any further thoughts on that.
Yes. I mean, if you're looking at house and land, there are some good options interstate. Sydney is getting obviously priced out for most people for house and land, but there are good investment options there. Now, having said that, the apartment market in Western Australia and Southeast Queensland, Brisbane, is hotter than the house and land market. And I think the same applies to Sydney. So where house prices, you're buying a small block of land in Austral for around 700 plus, building a house on it. Really, you've got 1.1, 1.2, 1.3 million now. So so people are gonna definitely get priced out of the housing market in our city, and this is exactly what happened to those other places like Western Australia and Perth and Brizzy. And so what comes becomes in vogue is apartments, and you will see apartment prices keep going up. And I mean, when you get to, maybe by 2030, another 5 years, there will be no apartments in Sydney below, brand new apartments in Sydney below $1 million. So this is what happens in the property market. You don't want to miss out. And I think, as Krish said, there's so much happening in Western Sydney. Uh, Location becomes very important. When we do a scoring on where you should buy properties, we use a 10-point scoring system, and you've got to have transport, you've got to have infrastructure, you've got to have population growth, you've got to have tertiary education. So you got TAFE universities. If you get a hospital, bonus, et cetera, et cetera. So this project actually ticks quite a few boxes for us, and that's why we're involved in it. We see the value in it. So if you're looking for a good investment or indeed a place to live, it is a good opportunity.
Definitely. The last question is from Victoria. Any extra incentives for this project? Yes, there are some incentives. Thank you for asking. Now, because we are at the launch phase at the moment, we've got either the option of timber floorboards in the living area as an upgrade, which the developer will cover. So that's one option. The other option is strata paid for 12 months as well. Yes, there's those two options there that we can speak of. So, but look, we can go into more detail. Please feel free to let us know if you want to come and have a look. We can go through all the pricing, all the incentives, and we can definitely show you through. give you a good understanding of the project. Any more questions, anyone? All good. No such thing as a silly one, so please feel free. All good. All right, guys. Thank you for your time. As I mentioned, I'm going to send you a copy of the display video. I'm going to send you a copy of the recording as well, in case you want to share it with anyone. We'll be putting it on our YouTube channel, and then we can go from there. But I really thank you all for your time. I really appreciate it. And Sachin as well, thank you for logging in from overseas as well. Much appreciated. Thank you so much.
Thank you, guys. Thanks, Sachin.
No problem. Take care, everybody.
Take care. Bye-bye.
Bye.
Cheers.